Here we have a bar by bar study of gold using a 60-minute time frame. For context, we're in a downtrend and we slowly start to round over like this, and this bar A breaks support. Okay, so bar A, what do we notice? Well, let's just compare it to the other bars. It has a wide spread, we'd say with fairly good volume, that closes off the lows. So we know that buying has occurred. Again, for context, this bar does break a support level and does so on good volume. So we know the break is valid. However, buying has emerged. Then for the next 10 hours or so, don't forget the 60-minute time frames, 10 hours or so, we trade sideways. There's no upside follow through from this buying. Then bar B grabs my attention. Slightly above average spread, closes firm with a little pickup in volume, a little spike in volume. And what's important about bar B is that we break these, we can see a local level of resistance. However, the force, as in the volume, as we can see, is not strong. And also, the drive to B, volume declines. So we'd say this is buying of poor quality up to B. However, we do break, closing firm, a small spike in volume. Then bar C instantly grabs our attention. We've seen this many times today. We have an increase with volume, more volume than B, with a spread at minimum half the size, if not a third of the size, with high volume. So we know that the market is finding it hard to push up. The thrust has shortened with increasing volume. Selling has occurred. So the effort, being the force of volume, is not rewarded, as in the result, which is movement from this close to this close, is what we call effort versus result. And this is a very important concept that we will go into detail next session. Next session we will concentrate on the 3 universal laws of trading, or Wyckofian laws. They are effort versus result, demand and supply, and also cause and effect. We will study these in detail next week. But anyhow, bar C is effort versus result. We can see with higher volume, with smaller spread, we make no upside progress to speak of, so we know that is riddled with selling. We then slowly fall. We then slowly fall for the next 12 hours, and then boom, we break via D. Draw this little level in. We break support with a surge in volume. Yes, again, look, the bar closes mid. So all this must be buying, but that is a valid break with a wide spread and surge in volume. We get ease of movement down. We drive down with ease. And then bar E. Tricky little bar to the uninitiated. We wouldn't say it's a narrow spread, would we? But it's half, these are narrow spreads here, but it's half the size of D. And it has lower volume than D, but closes weak. So we'd say, but think about the action of this bar for a minute. So from the close, buyers come in, they try to rally it as they pass this close. Buyers cannot sustain the buy-in, and then sellers come in and they push it down to close weak under the previous close. So we close here. And what's important about this bar is that although the volume is lower than D, it's in sync. The spread and volume is in sync. This spread is roughly half the size of this, and this volume is literally half the size. So therefore, the selling is actually fairly good on this bar, considering the volume. So this indicates that there is no force of buying left in the market, because they tried to push it up, then sellers came in with average volume to close weak. It doesn't look like we get good follow through for me. We don't fall down from here and close like this, but due to the action of this bar being in sync with volume, it suggests that sellers have won this bar. And technically, look, this is a down bar. We make that much progress with half the volume. So we're pushing down after rejecting the highs here. Bar F. Highest volume on the chart with the widest spread. That closes weak, practically on the lows. Supply has overcome demand on this bar. The force of selling is clear. The thrust has increased. We're driving down. And there's no ability to rally into the previous bar. Look, from here, this is how much the buyers could muster before sellers swamped it and drove it down hard. We instantly fall, and we do so very hard. So sellers at this point are in full control, no question. Then bar G. What do we note about bar G? Well, again, an interesting bar. It's a third of the spread of F. So it's a third of the spread, yet just over half the volume. So we know that buying must be present, and the thrust has shortened. We make no downside progress. There is no follow through. We can't even close under the lows of F. We close in line. Buyers step in at the lows to close it in line. This spread with this volume, we should be producing a spread about like this if it was full of selling. So we know buying must be present on G. And H. Average spread, declining volume with a mid close, well, slightly above a mid close, which is also more or less in line with G. So we get a mini cluster. This type of action is similar to that of E. If you think about it, sellers came in on H, they drove it down under the lows of G. So if sellers were here at some point, they couldn't find any further selling, then buyers came in and they close it back above the lows here and in line with this close. That's buying. And how do they achieve this? With very little force. So the question we ask ourselves is, where is the selling on H, which we have seen previously on D and F? So we have some shortening of the thrust here. We have a chance for lower prices that dips under, reverses to close in line with low volume. So the selling pressure seems to have eased off. This does not mean we go long. We just note that odds favour some kind of relief rally, a rally of sorts. And we also note that we have shortening of the thrust in the closes. Right here, okay? And bar F, at this point, we would not say is climactic. It's a good spread with good volume. Everything's in sync. So at H, we are just halting. For whatever reason, there's no selling present. They may have taken their foot off the gas. They had a good selling here, a good selling about here. Let me just repeat H. We do not buy this bar. We merely note that market is halting. Demand has not emerged on H. It's just halting progress. You know, there's no buying of good quality here. We're not driving up closing firm. If anything, we still want to be looking for shorts. We're looking for a weak rally from this point, which is why recognizing this behavior is important, because we would expect a form of a rally, and we're still looking for short plays, and this indicates a slight turning point, as we know, shortening of the thrust, a mini cluster. Okay. Then for the next 15 hours here, we kind of drift up. Spreads narrow, volume depletes. There's no real volume here. And we're unable to clearly break this level of level of resistance here, for whatever reason. There is a subtle tell that they want to break to the upside, and that's with the rising lows here. You can see price action, and then they're banging their heads against resistance here. And then J. What do we note about J? It has a wide spread. Why has it got widespread? Because we're comparing it to all these previous bars here for the past 12 hours, 13, 14 hours. It's wider than all this price action here. And it has a surge in volume. And what does it accomplish? Well, we break resistance with a decent spread. That closes firm. However, the volume, although it has spiked, is not high. Why? Because think about this. We're trying to drive through a resistance area and through this supply at F. And if you think about this, all the F is supply here. Look how much selling there is in this bar. And then we have this amount of force to break through resistance and to get through that selling is extremely unlikely. But price action rules. We don't know any of this is here. We break this level and close firm with a small spike in volume. However, the bars hereafter, these three little bars, show no follow through. It's very suspicious. Here we should be taking off. We've just broken this level of resistance. Why isn't there no upside follow through? This market has had 15 hours here to sort itself out. So once we break on this bar, surely we would expect some continuation to the upside. But we don't. We're unable to continue. Very suspicious behavior. And then K. Good surge in volume. Spread increases. It's a down bar. Yet we do close off the low. So it indicates a bit of buying. And we're none. And where's that buying come in? This little support here. So that's unsurprising that we do have a bit of buying here. However, this bar K is important. Why? Well, it's higher volume than J, and it wipes out all of this positivity. Can you see that? Bar K wipes out this potential break of this area in one swift move with high volume. So this accomplishes a great deal. Bar L. Surge in volume. Widespread. Think about this. From the close. Buyers drive it up. Over this high. Over this. Into the supply bar. Before sellers slam it down. Closing weak. Practically on the lows. And we only make that much we only gain that much to the upside with all this extra volume. Don't forget that is an extra 5,000 contracts, give or take here, and we only make this much difference. So this is a clear price rejection. This is what we'd call an up thrust or hidden up thrust, which will go into depth session 5 or 6, I believe. So we can short this bar very comfortably. We are in a downtrend with evidence of good supply. We try to hold, break to the upside with a fake break that instantly gets resolved by K. And then we drive up on L, up thrust this to reverse and close weak with a surge in volume, which is also in this area of supply. Odds favour at downside progress, even though although we can see it, odds favour from price action that we should be going lower. This is a price rejection, clear price rejection. Can you see how this all fits together? Okay, we have enough reasons to make a short play here. Then bar M, tricky bar M, tricky bar. It's good volume, average spread. That closes firm. It dips under all this price action and under K to reverse and close firm. Above this close, and that low and that low. So it achieves a great deal with fairly good volume. So this bar achieves something. And we would expect some follow through to the upside. And our line in the sand would have to be this high here. We would not want to see price close above this level. If so, we'd have to get rid of our shorts. And then bar N. Bars N here and here. What happens? Volume declines dramatically as we try to rally. Basically, these two bars are no demand. The force of buying is weak. It's clear as day. Spreads narrow and volume declines. We could take these two additional bars as trading opportunities or add additional contracts. If we are short from L and we see these two bars print, it's just confirmation. Our trade is intact. There's nothing to worry about. Then bar O. What do we note about bar O? Well, bar O is similar action to M. However, there are a couple of subtleties here which make bar O much weaker than bar M. The volume depletes on O. So M, we dip under, reverse to close firm on this volume. Here we don't dip under and reverse to close firm, but on this volume, much less volume. Bar M dips under K to reverse and close firm above these two lows and closes. We close firm, but under the previous two closes. So we don't achieve anything. We can't close even above the previous low, let alone two closes. So if you compare the nature of O to M, they are different. M achieves a great deal in price action. It accomplishes more with higher volume. So O is actually weak, although positive, looks weak. But again, we might expect a little continuation. And then boom, P. Why are these three bars at P good? Well, spreads again narrow with declining volume. Now, this is where it gets interesting. After M, we'd expect a rally, and we do so. At O, it doesn't accomplish anything, and we don't even get rewarded. We just drop, we just fall. Can you see the difference? Here we accomplish a great deal with high volume, we get continuation. Here we try to accomplish the same on lower volume, and we don't get any upside follow through, whereas we did here from M. So now we are in good shape. And then Q, picture perfect, no volume. That's an up bar. This is an up bar. There's no volume and an extremely narrow spread are in all this area of negativity in a downtrend where we have good selling behind us. And then demand weakening. Demand weakens from M to O. It depletes. So this is a very good high odds trade that we could take at Q. We have excellent context by using the background conditions. We're slowly piecing the story together for a trade. So we can short Q. Okay, it's literally no demand. We then drift down from Q for the next 14, 15 hours, and we get to R. Clearly, we could draw this in. We note that R breaks support with good volume, closes weak, good price action, valid break. There is no reason whatsoever that we would not think lower prices are on the cards from R. No reason at all. Bar S, surge in volume, wide spread, that dips under R and reverses to close firm, with a slight pop in volume. And it wipes out all the negativity from R. And that's interesting because S at some point was trading under R, but sellers could not take it down further. Buyers stepped in to close firm right at the highs. It wipes out all the negativity of R in a good way, in a good manner. Now, at S, yes, buyers wiped out the negativity, but they're not in control. They've merely emerged. They've made themselves present at S. Okay, we don't long here. We certainly don't go long. We are in a downtrend. This is just one bar that shows that shows that demand's in the market, but we don't go long. Far from it. Okay, why? Well, although they've emerged, it only wipes out the previous bars selling. You know, we're not closing above anywhere of structure as yet. It hasn't accomplished anything. Okay? And then T pops its head above S, reverses to close weak. Off the lows indicates a small bit of buying, but we have good volume, still in line with these. Yet we can't push down, and you can see that we hold above this, you know, we hold quite comfortably into S, but we are in a downtrend. Buyers had an opportunity here. Sellers came in to close it weak. So, for all intents and purposes, in the background conditions, we'll still give it to the sellers, although it's not convincing that we'd still expect lower prices. U-prints. Very high volume. Way above RST. Increases the spread. That closes 45% off the lows. Think about this bar. It's a bar of interest. Buyers come in. So they come in from the previous close. They push it up. Sellers come down. It dips under all this price action here and then reverses to close near the middle. And we do make a new low. But it is closed very much so off the lows with all this volume. So we know there's a great deal of buying in this bar. Why with all this volume? Don't forget we're on a downtrend. So why with all this volume from you are we not continuing down? Why can't we make lower prices with good volume in a downtrend? That's interesting behaviour. Yes, we've noted there's buying off the lows, and we even close above this low. You know, this actually accomplishes something. We're holding here. This is suspect behaviour. Certainly, this is not a bar we'd go long on you. But if we're short from up here or from here, and this bar prints, something's out of sync. With all this volume, we should not be holding. We should be making lower prices. So we may want to fully liquidate or certainly take partial profits. Try to think of you like this. With all this volume, we only net this much to the downside. With all that volume, very suspect. Makes me feel uncomfortable if I was short. Okay, my spider sense is tingling. Why? With all that volume, can sellers only make that much progress? That's what I'd ask myself. I'd note that on the chart. And then bar V. This is a key bar. U is a very, very big question mark. And then V is key. We have a wide spread with, we'd say this is average volume. Why? Because of our S and T. So it's average volume, wide spread. Up bar. Closes firm. Highest close out of all this price action. There are various subtleties of strength. There is no downside follow through from you. Just this tiny bit here before buyers drive in to close it firm. So we make good progress to the upside with average volume, which means we have ease of movement. And that we interpret as a lack of selling pressure. Only by using context do we know that V has average volume from R, S and T. So with average volume, the same volume, we have a spread like this, which is almost twice the size. So we're getting good flow to the upside. And an aggressive trader could take V for a long play. But the stop is pretty wide. Your stop would have to be under here. But that would be a valid play. All this price action here now makes sense. Good break, instantly resolved. Same volume, we hold higher, we don't really go anywhere. You, with all this volume, we net this much to the downside, so there we know there's a great deal of buying in there. And then V, we get good flow to the upside with average volume, which means there's no selling friction. Buyers are able to push the market up with little force, or not as much, or wouldn't say little force, but with average volume, they get a good result. Bar W, lovely little bar. Narrow spread, low volume, down bar, closes under. There is a lack of follow through to the upside as we can't test the highs. The volume is in sync, more or less, with the spread. So this indicates a lack of selling pressure. From here, compare the selling at W to R, T and U. Clearly, it's depleted. So this is a very good confirmation if we took the trade at V. Alternatively, we could make a long play here. Why? Well, because W, so V, we see good demand with ease of movement. And then W, we get confirmation. Why? Because this signifies a lack of selling pressure. Isn't it amazing how we can piece this all together bar by bar? Bar X, average volume compared to RSTV, we can see it's average, with an average spread, with a close off the lows mid bar. Now, sellers come in and they drive it down, but buyers end up holding and we push it up to close mid bar. And it achieves something. We hold above this low, this low, this low, this low. We hold above this close and this close. Don't forget the sellers had opportunity. They were here at some point. Yet buyers managed to come in and hold it above all this action here. So it appears as if we have like a mini buying zone here. Every time we come in around here, buying emerges. We discussed buying zones in session 7 or 8, okay, but something we'd note. Although if we are long from here or here, it may make us feel uncomfortable, but sometimes this action occurs, okay, and if we analyze it and what it achieves, so let's try to drive it down, but buyers step in and they close it mid-bar and it accomplishes all this. As I just spoke about, the market, in my eyes, is refusing to go down. And bar wire, boom, smaller than average volume, with the widest spread up bar, we can see on the chart that closes super firm. So with no signs of downside follow through whatsoever. So the manner in the way this bar prints is extremely bullish. And we can say that buyers are in full control. And the lower volume, we know what that suggests. This suggests ease of movement. Very good flow to the upside. It's got lovely flow to the upside. No downside follow through. We close extremely firm. We can't close right at the highs with less volume, which shows there's no selling friction in the market. So this whole area here is reversal action. By dissecting these bars, we could see the supply-demand balance shift. Selling. Buying came in and wiped out any negativity. We get more selling, but we hold quite a bit higher. Then we get all this volume on you. So all this volume, and we're in a downtrend. We only net this much downside progress. Tells me there is an awful lot of buying in the market, which shouldn't occur if we're in a downtrend. Agreed? And then V shows ease of movement, like we said. And then W, no supply. Then we come down, we test here again. Sellers have one more move, but buyers stepped in again, saving the day. And then boom, ease of movement, good flow. Okay. And importantly, if we were to draw this in, we close above resistance. Now, there is much more to this chart than meets the eye. Let's add structure. Now we have structure, it completes the story. Bear in mind, there are channels that you can draw, and we're oversold because we're in a downtrend. But it became messy drawing all the structure in, so I wanted to keep it clean. So when we add structure, we can see we get a good break of support here. Then as we break, what should happen to support? It should turn into resistance. Bang. E respects resistance perfectly. Now bar E makes much more sense. And then here we form an apex and we get a good break. Okay, validity is a bit suspect for all intents and purposes. We do break with a surge in volume. We have covered some work on the formation of apex and what should occur on session 1 in structure. So we should know that we should get a decent break with continuation. The purpose of an apex is to build cause. You know, we can see price tighten. It gains energy. We don't look at the individual bars. Think of the apex as an entity of energy, and when we break, we want to see bang continuation to the upside. We don't want to flounder around here. Think about that. That's just 3 hours of trading and we can't continue. It's very suspect. This should not occur from an apex. So in my mind's eye, ding 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 ding, you know, something is off. Something is off. Again, structure wasn't added, so we can focus on the bar volume relationship, to focus on the process and build the story. Because when we add structure, it becomes much easier. And we see resistance here, and we can see from bar L now the clear price rejection, can't we? And the fake break becomes a lot more apparent from J, and the sloppy price action, and the clean break here, and the test here. Okay? So this was a study of price volume alone, where we can read, gauge the buying and selling pressure. Of course, it would be easier with structure. I just wanted us to focus on the simple bar volume relationship. I mean, with structure added, clean, simple break at D, test at E. Coil, break at J, no follow through. L, lovely up thrust where we reject local resistance. So deleting all the structure, it focused our concentration, reading the imbalance between the bar volume relationship as it unfolds. There is another principle of vital importance, which is here. We have this new support line drawn in, and this grey area. This grey area is highlighted all this price action and all this volume. The purpose being, when we see a swell in volume and price hold, I mean consistent volume, if we look here, we can see this is high consistent volume. This is high volume, but only on 2 bars. But here it's consistent. So a swell in volume and price action like this often indicates a change in the current trend for the time frame we're trading. Think logically. Think about this action logically. Don't forget, we were in a downtrend. We can't see all the chart. We round over and then we come down. So we've been in a downtrend for 4-5 days. We're making lower highs and lower lows. And when we break this support here and price holds, we hold here, why can't we make progress to the downside with all this volume like we did here and here? We get good volume and we drive down. Here we get a swell in volume, consistent volume, and we hold. Why? Think of it like this as well. Add this into the mix. From this upthrust, we grind down. We break support. Agreed? Where's the volume? Look at all this volume over here. We know it takes equal or greater volume to break a previous area of support or resistance. Where's the wide spread? Where's this this is the action we need. This is the spread we need to break areas of structure. Here, we grind through with no volume. Something is suspect. And if we combine it with all this price action where spreads increase with all this volume, and we cannot continue lower with this volume after we grind down like this with this volume, all this volume, and price not moving, there's only one thing can do that, and that's buying. Only buying can do this. Don't forget, we're in a downtrend. We can't make lower prices with all this consistent volume. Has to be buying. They are holding the market. And if we analyze a highlighted area like we did, we can see the transition between the forces of demand and supply. We went through it bar by bar. So all this activity represents the battle between the buyers and sellers. It takes time and effort to halt a trend. Don't forget, we've been in a trend for a few days. It takes time and effort. We don't get V spike reversals. That only happens, 12 to 15% of the time. Think about what's occurring in here. There's a transition coming from sellers to buyers, and that doesn't occur on one bar. We become sellers to neutral to buyers, all in this area. Hence the swell in volume, which is of course activity. Ergo, a swell in volume is an extremely important concept that occurs on all time frames. And we want to see this at the end of a move, an established trend. This is a 60-minute time frame and a fairly good trend that has lasted for a few days. And if we draw this channel, what do we know? We also have a reverse use of trend line that holds. So we're having all this action, all this volume at a potential demand line, or at the demand line where price is unable to test the demand line, which is another subtle sign of strength. This action here is another way of reading a market turn. I find this stronger than shortening of the thrust and clustering of closes. Although very important, the very nature of the swell in volume here is the battle It's the transition between the forces of supply, in this case, turning into buying. That's what this volume represents. That is what's occurring in this price action. We're shortening up the thrust. We push up, we push up, we push up, we push up like this. So buying pressure is easing off, but it doesn't mean that sellers are in control. Here is a full transition between the sellers into buyers. Okay, can you understand that concept? I mean, here buyers diminish, sellers aren't in control. Here sellers come down and then end up with buyers in control. Big difference. A full transition occurs. This is very advanced reading. Not many people can read this price bar volume relationship like this and understand its importance or understand the background conditions, helping us to tell the story of strength or weakness. This takes time, but well worth the effort to learn. Excellent. Are there any questions? Do you need all concepts to trade? What I'm doing here is introducing the concepts in a logical manner. I'm going to share all the principles and concepts with you I know. But what we do is to combine certain principles, amalgamate them to make our own individual setups, which we'll go through. Session 10, I believe. We don't use all of them all of the time. I don't use bar by bar analysis all of the time and analyze every single bar. What I do is I simply draw my structure. Okay, then I would look at important areas. I'll notice shortening of a thrust, or we have an up thrust part where we're at structure, we're at resistance, confluence. Okay, I take the trade. You know, if we're in a downtrend, I want to see that sellers are in control. And if we're rallying, I want to see weak buying. I mean, a few months back, there was a channel on my watch list that had a swell in volume for 3 solid weeks. And when I mean a swell, this was a massive surge in volume, like this. And the average bars, and we were in a downtrend for about 9-10 months, the average volume coming down was like this. Became oversold in a channel with volume like this, and we did not go anywhere. I looked into the channel by bar analysis with this swell. I just saw good buying, good buying, good buying, good buying, high volume, high volume. Looked at the selling. Selling was weak towards the end. The volume dried up completely and the spreads narrowed. Instantly bought. Why, with all this volume, are we not coming down in a downtrend? It did take another week to develop, but then boom, I put my stop underneath and it went off and I held the trade for 3 or 4 months. We don't need to sit down there and just analyze or think of every single concept. It will become apparent once you understand. We need to go through the concepts and the principles, and we need to understand what they mean within context of what's occurring to the left-hand side of the chart. Like having a swell in volume in the middle of a trading range doesn't help. Does it? It doesn't help me. I couldn't tell you what that happens. But if we're in an established downtrend that lasted 9 months, and then we get to this area here, then we have extremely high volume for 3 weeks or a month, and we hold, yet we've been in a downtrend. Why? That can only be buying. And if we analyze the bars in this action, and we can see good buying and then weak narrow bars like this for selling, we simply buy. Put a stop underneath and let the market unfold. Okay? Trading is only as complicated as we want it to be. It's in our mind's eye. Trading, I will not use the word simple, but price can go up or down. How does it go up? with buying. How does it go down? With selling. This is what we're doing. We're decrypting the forces of demand and supply. Demand is buying. Supply is selling. This is it. This is trading. Yes, I know we can go sideways. But when we do go sideways, it goes on our watch list. Why? Because we can recognise buying and selling within a trading range, which is either accumulation or distribution, which we'll go through next session. Anyway, apologies for the rant. Okay, it appears there are no further questions. On to the next chart.